Welcome to my YouTube channel on financial accounting. My name is Michael Mwansalioba. I'll be dealing with introduction to financial accounting in this series. We start by looking at what is the definition of accounting. Accounting can be described as the process of identifying, measuring, recording, analyzing, and summarizing economic information, and finally communicating to various stakeholders. Let's analyze this definition. The word process is indicative that steps are followed in accounting. It involves identification, which denotes accounting is only concerned with activities or transactions related to the business. It involves measuring, which denotes all activities of the business should be measured in monetary terms. It also covers the recording, which denotes writing down all business activities in appropriate accounting books. The recording aspect of accounting is called bookkeeping. This also takes care of analyzing and summarizing, which suggests all recorded activities are summed up by preparing financial statements or financial accounts. That is, statement of comprehensive income, statement of cash flow, and statement of financial position. We're going to understand what these statements are in subsequent presentations. For now, it's adequate to know that they are these statements. We also have in the definition reference being made to stakeholders who may wish to look at the accounting statements and make decisions. Who are the users of accounting information? We have a number of interest groups whom we call stakeholders, and we are going to show or going to reflect or go through some of their areas of interest. For instance, if you talk about management, which is the first group of stakeholders, their interest is for control and decision-making purposes on how best to run the business. We have the shareholders to assess profitability of their company or assess the management team in terms of efficiency. We have suppliers or indeed customers who are there to assess the company's ability to pay its financial obligation. We have lending financial institutions. They want to be assured the company is capable of paying interest as well as pay back loan. On the other hand, we also have tax authorities. Their interest is on companies' profits for tax purposes. They want to know that the company or the entity has given them accurate figure of profits on which they are going to base to calculate the tax. We have employees who aim to negotiate for better condition of service and what is their future with the company. For the employees, this information can be obtained by analyzing the financial statements. We also have financial analysts who want to give appropriate financial advice to clients on investment matters and other financial issues. We have the government who are particular about how well they are going to allocate resources and also want to obtain national statistics to inform the national policy. We have the public. For them, they want to know whether the financial statements are assuring in terms of guaranteed employment. They have looked at maybe take certain environmental issues. They look at the guarantees of adequate public goods and services, and also use of local suppliers. Now, we are talking about information. For information, we have seen most cases people need good information for them to give or come up with good decisions. So this information feed into good decision-making processes. So in this case, we are worried about quality of good accounting information. So we are going to look at a number of elements or features or characteristics that are expected in a good accounting information system. The first one is relevance. This information should be relevant in the sense that the information to be provided should influence action by those using it. It should satisfy their needs. This information should be desirable in order to make appropriate decisions. Then it is relevant. We also look at reliability of information as a quality. The information provided must be relied upon by users, and for it to be reliable, it must be independently verified by independent auditors with approved qualifications. It is information that is dependable in order to draw reasonable conclusions and make appropriate decisions. That's what can be related to as reliable accounting information. It should also carry the aspect of completeness. For this feature, the information provided needs to be complete in all aspects. It should depict a complete picture of the business activities. Furthermore, we cannot avoid this particular quality of comprehensibility. The information provided must be easy to understand and deal with details which can cause challenges. The accounting information should be objective. So we talk about objectivity. The information provided should be free from bias. Accounts should not express their opinion. For information to be free from bias and opinion, it should be verifiable. We also talk about timeliness. This information provided might be rendered useless if it is produced at the time when it is not required. Accounting information should be produced in the period to which it relates so that timely decisions are made. We also look at another feature or quality of good accounting information, which is comparability. For information to be useful, it should be produced on a consistent basis so that valid comparisons can be made with information from previous period and information from other sources. It will be very difficult to compare unlike items because there will be a challenge to know whether you are doing better or you are getting worse off. So when it comes to analyzing trend analysis in most organizations, we rely upon information that is comparable from period to period. We come to look at the scope of accounting information. What does it cover? It covers a number of things. Amongst them, accounting statements which are prepared and presented in monetary terms. And also, we need to note that not all items which contribute to the success of a company can be measured in monetary terms. There are items like good management, dedicated workforce, skilled staff, business environment, clean environment, etc., which are not expressible in monetary terms. It brings us to the question, why keep accounts? An account, as we know it, is simply a record or explanation of a transaction. We also need to look at the purpose of keeping an account or a record, which should be 1. To have control over resources. 2. To have knowledge of what the business owns and owes. 3. To calculate profits. 4. To prepare cash budget. Therefore, accounting statements may cover the following: profit earned by business, assets and liabilities, cost of production or selling a product, cost of running the organization, quality of the product to be sold, cash coming in and cash going out of the business, to name a few. Furthermore, it's required for effective planning, financial planning. It is required to aid the efficient running of the business, to indicate how successful the managers are performing, and to provide information about resources and activities of the business. Having looked at the purpose, we also need to look at management and financial accounting. Management accounting and financial accounting. Financial accounting is mainly concerned with production of financial statements for stakeholders. To achieve this, the business must keep a record of all transactions related to the business in order to account for the way in which the funds entrusted were used. Furthermore, management accounting, on the other hand, is concerned with need to know or a great deal about the detailed workings of the business. This knowledge must cover production methods, the cost of processes, products, services, etc. Financial accounting is not there to provide such details, which management accounting does, and therefore the managers require accounting information geared to their own needs, which include formulation of strategy, planning and controlling the activities, decision making, optimizing the use of resources. Having looked at financial accounting and management accounting, let's take a break, or let's look at how we can contrast the two. So we can contrast the two using a number of reference points, which include 1. Users of report. Who are the users of these reports? Financial accounting are predominantly for external users, who may include stockholders, creditors, and regulators. Whereas managerial accounting are predominantly meant for internal users, which are managers, officers, and other employees. When we relate the two to types of reports, I'm glad to tell you that for financial accounting, it generates reports such as financial statements, which include statement of financial position, otherwise known as balance sheet, income statement, previously well known as trading and profit and loss account, cash flow statements, to name a few. Whereas on managerial accounting, internal reports include job cost sheet, cost of goods manufactured, production cost reports, etc. Let's talk about the frequency of these reports. Under financial accounting, you can have the frequency as quarterly or annually. Whereas for managerial accounting, as frequently as needed. It can be on a daily basis. Management wants a report before they commence a day or at the end of the day. It can be on a weekly basis, it can be on a quarterly basis. So we can say for managerial accounting, the reports are generated as frequently as needed. Purpose of reports. Financial accounting aims to help those external users make decisions on credit terms, investment, and other decisions. Whereas managerial accounting targets internal users in planning and controlling decision-making process. Let's look at focus of reports. Financial accounting helps or pertains to company as a whole, that's its focus, and uses generally accepted accounting practice structure. Financial accounting are composed from a multitude or combination of other more individual data. Whereas for managerial accounting, it pertains to departments, sections of the business with very detailed reporting. No generally accepted accounting practices constraints are required. The reason for managerial accounting to have no generally accepted accounting practices is because these are standards. And for managerial accounting, it tackles with various kinds of problems or challenges which are unique and cannot be, in most cases, be solved by using a standardized manner of solving problems. We move on to look at nature of reports. You should understand that financial accounting is monetary in nature. We cannot record that which cannot be expressed in monetary terms under financial accounting. Whereas managerial accounting, it covers for monetary as well as non-monetary information. We got to look at the verification of reports. It's by law that when the company or entity reaches a certain threshold, the financial statements should be audited at least once in a year, and they are audited by certified public accountants or chartered accountants. For managerial accounting, the auditing is not compelled or imposed, or they are not forced to have their managerial accounts audited. There is no independent audit really required. So with this, we come to the end of today's session, and I thank you for listening very tentatively to my presentation. Please don't forget to subscribe to my channel. See you next when we meet.